Welcome to the Lend Academy podcast, episode number 202. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend at Fintech conference. Today's show is sponsored by Lend at Fintech Europe 2019, Europe's leading event for innovation in financial services. It's coming up on the 26th and 27th of September in London at the Business Design Centre. We've recently opened registration as well as speaker applications. You can find out more by going to lendit.com/Europe. We have a fascinating guest on the show today. Giles Andrews has been around fintech since the very beginning. He was one of the co-founders of Zopa back in 2004. He was CEO for many years, led them through the financial crisis and beyond. And he was chairman of the board until earlier this year. He is now a director there, but has chairman responsibilities at several companies, some of the leading brands in Europe and companies like Market Invoice and Creditech. He's also chairman of a company called Dynamic Credit, which is a very large lender in the Netherlands, and as well as Bethnal Green Ventures. And he has other board responsibilities as well. But in this episode, we dig into the origins of Zopa. We talk a lot about what the team was thinking back then and how that has evolved over time. And Giles also gives us his perspective on the UK fintech scene today. It was a fascinating interview. I hope you enjoy the show. Welcome to the podcast, Giles.
Hi, Peter.
Great. So I'd like to get these things started. I know you've been in fintech now for just about longer than anybody, but I'd like to go back before that and give us some background about what you did in your career before Zopa, if you can remember that far back.
I'm not that old, Peter. I can remember that far back.
Okay.
And it had nothing to do with financial services or technology. So very different. So when I left college, I actually went and worked in the motor industry, which was fulfilling a sort of childhood ambition, really, to mess about with cars. I mean, it got a bit more serious than that, but I think that was why I started there. I had this view that if you followed a passion, then you might end up doing it competently or even well. And I got very lucky. I met some interesting people and started a business 4 or 5 years in my sort of mid-20s. And if you remember this far back, the early 90s, 91, 92, it was a very severe recession, particularly in the UK, but pretty globally as well. And car businesses were going bust left, right and centre. And we put together a team that we took control of a shell company that was listed on the main London Stock Exchange and used that as a vehicle to build a dealer group, a sort of a regional dealer group, so not a national one, but one that covered probably about a quarter of the country, and built that up over the course of the 1990s and sold it in the late 90s. And timing was everything. We sort of got in at the bottom and managed to sell out reasonably near the top. You never pick the top, but sell out reasonably near the top. Mm-hmm. And had an absolute ball. Really enjoyed it. And I think scratched the itch that I then sort of decided I didn't need to spend the rest of my life working with motor cars, but I'd had a really good time along the way. And it's something I always say to people, young, who are terribly concerned about what they do for a living and what career they pick. And I think they tend to often pick very conventional, safe choices that maybe their parents or their university careers officers recommend. Mm-hmm. And actually, if you go a bit more left field and just find something that you're really passionate about, the chances are you will do it better, and you might even stand out.
Right.
And with a bit of luck along the way, I think you can get a great training in business. Because at the end of the day, when you start out, your first job, the work you're doing is not that exciting on the whole, whatever it is. So if at least you're doing it in an environment that stimulates you and you find exciting, then you can put up with a bit more. And no regrets. Really enjoyed it.
Mm-hmm. So then, how did you go from that to being a co-founder of Zopa? What was the genesis of like the formation of the company?
Well, I took myself off to business school. So having had a great time in the motor industry, I suppose the one frustration I had was I hadn't really used too much of my brain. So I had a yearning to go back to doing a bit of studying, and I took myself off to business school in France and also had a bit of a yearning to live in France for a year, so that was good fun. And one thing, I met some really interesting people, one of whom went on to become a co-founder of Zopa with me 4 or 5 years later, or 5 or 6 years later, I think, to be precise. But also, I think one of the great joys of business school is if people are at a sort of a crossroads in their career, it gives you a chance to think about what you want to do. And I actually ended up a few years later running a business of my own that was doing some consultancy advice, sort of strategic consultancy advice into the motor industry, which was obviously something I understood quite well. And I think business school had given me the tools and techniques to at least credibly present a consultancy service, but also doing a bit of angel investing and helping startups raise money. And I suppose that was my first introduction to the startup world. I wouldn't say the fintech world because it didn't exist, and it wasn't typically in financial services. They were quite traditional businesses, but they were coming out of the dot-com era, so there was technology involved. And I found actually the startup scene really interesting, and made a few investments, did okay, decided that wasn't for me. I wasn't going to become a lifelong investor. I didn't have enough money to do it properly.
Right.
And in that period of helping startups raise money, I got a phone call from a guy called James Alexander, who I'd been to INSEAD with, who said, well, he and a number of people had just left the digital bank Egg, which was the first online bank in the UK. And they had a mad idea, which had a working title of Rialto, which is a bridge in Venice linking two market squares. And it was eBay for money. It was this idea of peer-to-peer lending that I thought was just extraordinary. And so I joined that outfit in very early 2004, not yet called Zopa, and joined them actually to lead a project to help raise the first funding for the company. And we hit the streets in London in summer 2004, at a time when the VC community was just beginning to wake up from the dot-com crash, and the better players still had some money. I mean, no one had raised any money for a while, but the better and bigger funds still had some funds left over from the dot-com boom days, and we're just beginning to think about deals. And of course, what had happened this sounds terribly historic now, but what had happened in the dot-com boom was huge amounts of capacity of being built up, which then didn't get used as everything crashed and burned, but leaving behind some infrastructure that allowed people to build what was then called Web 2.0 businesses, which were sort of, collaborative businesses that depended on their users for content. So YouTube, if you like, came out of that era, and businesses which were more interactive. So there was a trend going on that consumers were beginning to adopt the internet in a different way. It wasn't just e-commerce. It was people were beginning to interact more deeply. You saw the beginnings of social networks. I mean, the leading social network in the UK at the time was MySpace. Well, Friends reunited initially, and then MySpace, and then, of course, Facebook. But people's behavior was changing, enabled by technology. And the team had this radical thought of, could you apply those changes to the world of financial services, which, if you think back to 2004, was a pretty staid affair. And the online banks had simply taken a green screen from a call center and stuck a web interface on it and called it an online business. But the online financial services world had no interactivity with its customers, and its customers weren't really involved. They were passive takers of a product. And I think the radical thought that came before the business model of peer-to-peer lending was, can we look at financial services using this new enabling technology to build a business that customers are more involved in? And from that thinking came the business model that we all know today as peer-to-peer lending.
Right, I know it's fascinating to listen to that, because it really is. You thought of it before anybody else. I mean, others I know are thinking about it independently or elsewhere in the world, but hadn't launched anything. But it was interesting that you guys were the first. And do you have any idea? I mean, what was, when we were first getting started, I presume you just wanted to try and create a viable business. You weren't thinking this was going to be the start of this massive worldwide movement. I mean, did you have any idea the impact of what you were doing?
Well, yes and no. So we certainly didn't think in global movements, no. But we did think we'd build a huge business, because the arrogance of youth and the naivety of the startup world, we just simply thought we had a better model. And once you beyond the sort of technology enablement I talked about before, the actual business model, the financial linking of people who have some money to invest and people who want to borrow, we thought was radically simple. And the simplicity would drive value, and technology would help drive that value and also to drive great service. And we just thought this was better. And we would probably be launching a bid for Barclays Bank in a few years' time. So we were hugely ambitious to build a UK business. But we didn't think that far beyond that. I mean, we did think we'd like to take the business to the States because the States is a huge market. And at the time, there was no, I mean, Prosper came a whole year after we launched in the UK.
Right.
So there was no hint of anyone doing it in the US. And in fact, our choice of our Series A investor, which was then called Benchmark Capital, now renamed Alderton, but was Benchmark Capital then, was, at the time, more closely linked to Benchmark in the US. And they were the sort of granddaddies of peer-to-peer in the sense that they led the Series A financing of eBay. And in the UK, Alderton or Benchmark UK had backed one of the businesses that ended up becoming Betfair. So in fact, they had backed Betfair. So the routes that led to that particular choice of investor. But we were overwhelmed because none of us had actually ever really raised venture capital at scale. I mean, I'd helped some startups raise very small amounts of angel money. None of us had ever raised venture capital at scale. And we were overwhelmed by the response of London, the London community. We had lots of term sheets, lots of conversations going, because it was a big idea. And I think people bought into the enthusiasm and energy and ambition of the team.
Right. Well, one more question before we move forward to today, but I'm curious about your decision to really focus on the prime borrowers back then, because that actually, obviously no one knew there was a financial crisis coming. It served you very, very well, and your counterpart in the US, Prosper, really decided that they would open it up for pretty much anybody. So what was the thinking behind the focus on prime borrowers?
Well, I think it was actually a very controversial decision at the time. So pretty well everybody told us we were wrong. Mm-hmm. So anyone who wanted to sort of lob in some free consultancy, or even board members and investors, was sort of saying, this subprime lending business, it's got much higher margins. Surely you should do that. And we had two reasons why we didn't. So, three reasons actually. The first one was that we believe quite strongly in sort of loss aversion theory. Behavioral economics tells you that we all, as humans, as irrational humans, tend to value losses in a much greater way than we value profits. We sort of bank our profits, but we get very excited about losing money. And given that we were going to be inviting people to lend on a website they'd never heard of, money to strangers on the internet, we figured that building trust would be kind of important. So that was, I think, quite sensible, but perhaps pretty obvious. But I think the slightly less obvious strand from that is to say that people will get very, very excited when they lose money. I mean, excited in a negative way when they lose money. Mm-hmm. And we just thought that offering people a time, I think, probably a 6% gross return that would turn into a 5% net return with very low level of defaults would be a much more popular proposition than something that lent out at 15% and had 8% defaults and a 7% net margin, even though the 7 is bigger than the 5, because people will get really, really angry about losing money. Right. Plus, operationally, as a startup, we wanted to build the simplest business possible. And we thought, well, if we lend money to prime consumers who on the whole repay, we don't need to build a great collections function. So that saves one thing to do, because losses won't come for 6 to 9, 12 months, in any event. So that's one less thing to worry about. And it makes the business operationally more complex. And actually, if you look back at one of the biggest criticisms that Prosper had, one, I think we've proven right, that behavioral economics was right. People did get very upset when they lost money. Mm-hmm. But two, the complaint was then directed at the company, because the perception was the company was doing a bad job collecting the money. So, I mean, I used to sort of read the chat forums at the Prosper site before they got removed. And the angst was more around, what's this company doing about this? They're not doing anything. Right. No, I've found, on the internet, I've found the borrower I know who lives at 23 Acacia Avenue. And I know he's got a new car. Why isn't Prosper going around and getting the money off him? And of course, you can't do that. No, it's not a practical suggestion. Yeah. But I think the noise and the loss of goodwill was enormous because the perception was the business wasn't in control and wasn't acting on its customers' best interests. And so we didn't have any of that. And so it was nothing to do with being really clever and foreseeing the subprime crash. I wish we could say it was, but it wasn't.
Right.
It was the conservatism based around thinking that we didn't operationally want to deal with a lot of defaults, and we didn't want our new asset class, which depended completely on trust, to be blown up by the noise of losses occurring. Mm. And I think lastly, and equally importantly, actually all of us were slightly averse to the idea of lending money to people who, in many cases, couldn't repay it. We just thought it was distasteful.
Right.
And, none of us thought we're building a business here to actually make people's lives worse. And I think subprime lending executed badly actually generally makes people's lives worse rather than better. Mm-hmm. And I think prime lending to finance people's hopes, dreams and aspirations and projects to improve their life is much more socially beneficial.
Right. Right. So then let's fast forward a few years. Then you become CEO of Zopa. You're CEO for many years. You bring in a Capital One executive, Jaydev, who we had on the show a couple of years ago. And one thing that I'm curious about, and I've never heard the answer to this, when you brought Jaydev in, obviously to a senior position, was it Jaydev that brought the idea that Zopa should become a bank one day, or should have a banking division? Was that, or was that percolating before Jaydev's arrival?
No, it wasn't percolating before, and it wasn't his idea, and it wasn't my idea.
Okay.
I think we all have to be very honest in life about what are our ideas. No, I mean Jaydev joined as COO in 2015, and with hindsight, has turned into the most extraordinarily lucky and good hire. I mean, life is all about hiring good people, but there's a lot of luck involved, and you can put as much effort and energy into doing it well, but there's still luck involved. And there's always been a great meeting of minds from when we first met through to today. And what we were looking for in hiring him was someone who had a background in bigger businesses where he understood the value and benefits of structure and sort of a degree more formality, because we were by then sort of 100 people and still running in that slightly chaotic startup style. Mm-hmm. And I was getting frustrated as the CEO because doubling the headcount didn't double the productivity of the business, and therefore we were getting sort of diminishing returns from our investment. And I just thought I needed some help. And he had a really interesting background because, as you know, he's got a background steeped in credit risk management. But at Capital One, they tend to make their risk analysts into marketing people as well. So he understood both sides of the business. In fact, they sort of meet in the middle in Capital One. So I think it's a really interesting structure. But he'd also managed quite big divisions of the business. So he'd run the collections practice, which was hundreds of people, mm-hmm. and with performance management and all that kind of stuff, which was all new to us. So there was there was great benefit in bringing that kind of skill and experience. But we clearly wanted someone who had an entrepreneurial flair as well, and that makes the population rather small. It's probably not so difficult to hire people with the right level of operational experience, but hiring them with some entrepreneurial flair as well, and that sort of startup culture, as opposed to big company bureaucracy culture, was the challenge. Mm-hmm. And that's where we got very lucky. So when he joined, he effectively took over managing pretty well all the internal functions of the business, and I became much more externally focused. And after a year, we looked at each other and thought, well, actually, you're sort of running most of the company. Why don't you become the CEO? And I became chairman. But at that point, what we did day to day didn't change. And I carried on managing some external relationships, and he carried on managing the internal affairs of the company. But the promotion was really a recognition of what a brilliant job he'd done, and the fact that he had effectively taken over most of the management of the business. Mm-hmm. And then over time, I began to hand over some of those relationships and took over time more of a step back and became a more conventional non-executive.
Right. So you got to answer my question though. So where did the idea come from?
Sorry.
For the bank?
Sorry.
Yes. That's okay.
Well, I actually can't remember where it came from. I mean, it came out. Actually, I think it came out of board discussions. So it shows the value of a good board. Mm-hmm. And We were playing in an increasingly prime world where the cost of, the headline price charged by prime lenders was on a, ever downward trend. And it's becoming increasingly challenging to sort of meet the cost of that lending and offer a reasonable peer-to-peer return given the risks involved in peer-to-peer lending. So that was what sort of made us start to think about it. But we also had a keenness to expand the product set. And this is perhaps where Jed's experience was more relevant, in the sense that he came out of Capital One's credit card company. So his DNA was credit cards. He'd always wanted to try and find a way to introduce credit card lending into Zopa. And he'd identified quite quickly that even before he joined, we'd built very capable risk management systems. He was quite impressed by what he found, very good data analytics, and good user experience, such that we win lots of awards for the quality of our service for our personal loans. So we had some building blocks that suggested we understood consumer credit, we understood how to price it, and we understood how to present it to customers and sell it. So it seemed natural to think, what other consumer credit categories are there that are big? Well, obviously credit cards. And we struggled to work out a way to fund credit cards through peer-to-peer investing, because a peer-to-peer investor understandably wants a return on his or her money all the time. And a credit card is a facility that goes up and down. So you've got to have the money available to lend. And ultimately, we came to the conclusion that the best funding vehicle for a credit card business would be a bank funded by retail deposits.
Right.
So that was the sort of the genesis of the idea. Now, once we come up with the idea of the bank, obviously JDev then really latched onto it and ran with it because it became a solution to something that I think he'd always thought that Zopa should ultimately move towards.
Mm-hmm, mm-hmm. Yeah,
as in credit card lending rather than necessarily taking bank deposits.
Right. So maybe you could explain for listeners exactly how Zopa is structured these days, because you have got preliminary approval for a banking license. You still haven't really started that up, but from my understanding, is that there's like the two entities that are completely separate now, with separate boards, separate CEOs, and just explain exactly how it works these days.
So we'd always had one business. So Zopa actually had a holding company structure, but that's not relevant really to your listeners. But we had one business, and that was our peer-to-peer business. So we had one board, one CEO, and a set of shareholders that were interested in that one business. It became very clear that the regulators would want to see a separate business applying for a bank license and getting a bank license and being operated as a bank. And as soon as you start separating it, you then enter into a sort of a challenging question of how do you manage the conflicts of interest between two different businesses. And you can do it while retaining them in the same business with sort of very detailed service agreements between different bits of the business, or you can choose to separate them for governance purposes and allow those two businesses to interact via complicated service arrangements and contracts. And that's what we decided to do. And it satisfied the regulator's need to see a bank that was separate. And they didn't want to see directors on that. They didn't want to see shareholders on that bank board. They wanted to see a majority of independents plus management. Mm-hmm. So it became quite clear quite quickly that I wouldn't be the right chairman of that business. So we went out and hired. So I seem to spend most of the last couple of years hiring board members. So we built a bank board, which is independent, got its own very capable chairman, and now 4 independent directors, including him. And that meant that all of a sudden we couldn't, as shareholders and the holding company group, manage the peer-to-peer business alongside that, because that wouldn't be appropriate governance, having the bank reporting into the group, but the group directly operating a peer-to-peer business. So we therefore had to create another board to steer and provide the governance framework for the peer-to-peer business. And that's the board that Christine Farnish, who I know you've also interviewed, became the chair. And that had to have a majority of independent directors. So we went and hired 3 independent directors for that business. And that left the group board effectively being the place where shareholders sit, and ultimately, long-term strategy is discussed. But the actual operation of the businesses occurs at subsidiary level. And as you say, we've got JDev as the CEO of the bank, and Natasha Weir is the CEO of the peer-to-peer business.
Right. And so I know you stepped down as chairman in February, I believe, but are you...
So that was the last bit of that was the last bit of board building I did. So having built the sort of, the bank board and the peer-to-peer board, we then sat down and thought about what should the group board look like,
right,
and what should the direction of travel of that look like. And I think ultimately that will involve a smaller board with fewer investors on it. Certainly the PRA would like to see, the regulators, I think when there's a dual board structure of a holding company and a bank, they obviously want to know that the right decisions are occurring in the right places, and that the group board doesn't meddle and doesn't play too big a role in the management of the business. And one way to satisfy them is to make that increasingly independent as well. So that's the next sort of journey we're on. And step one on that was to recruit an independent chairman of the group. So we identified Gordon McCallum and hired him earlier on this year as the first fully independent director who sits on the group board. The chair of the bank and the chair of the peer-to-peer business also sits on the group board.
Right, and so you're on the group board. You're on the group board as well.
Yeah,
is that correct?
So yes, I am. I mean, I'm obviously a significant investor in the company, and hopefully have my experience has some benefit which I can bring to that board. But I think the direction of travel was to create a more independent board. And I also to begin to position, I don't want to get ahead of myself here, but begin to position the company on the journey towards potential IPO.
Right.
Where you would require, and therefore you want to begin to build a team. It's going to take a couple of years at least to do so, but you want to begin to position yourself for that process. Right.
Okay, so moving beyond Zopa, you've got many business interests these days beyond Zopa, and I just want to run through a couple of these because there's several that are very, I'm sure our listeners would be very interested in. And the first ones I want to talk about is Market Invoice. I mean, we had Anil on the podcast last year, and it's a company that is probably pretty well known around the world these days. But so tell us why you chose Market Invoice and what just an update on that company.
Well, so Market Invoice is an invoice discounting plan. So it's not a peer-to-peer lending business, but it uses money from a variety of sources, including individuals, high net worths, and some institutions. So there's sort of slightly peer-to-peer flavour to its funding. It doesn't lend because it buys invoices as a discount to provide working capital. So it's not strictly speaking a lending business, but ultimately, it's a credit business in the sense that we have to make decisions as to which invoices are going to be repaid. So we provide working capital to SMEs. I've known Anil and Ilya, his co-founder, for many years through initially the Peer-to-Peer Finance Association and just generally, the London fintech scene. And I've always liked the guys and thought they had an interesting business. And they took on some fairly, they took on some venture capital funding from an investor I know well, Northland. And that often comes with suggestion to start creating some independence in governance on the board. And therefore I was sort of approached, if you like, from two different angles. I knew the founders and I knew one of the investors. And so I went to have a chat with them and liked what I saw and was interested in the thought that Market Invoice was at a stage of the journey that I had been through, made tons of mistakes, but hopefully learned some stuff from those mistakes and therefore would have something to bring in the scaling of another fintech business using technology and a different funding structure to provide value to a different set of customers, but many of the same principles. Mm-hmm. And I've been chair there for about 2.5 years and really enjoyed it. And we've been quite successful in the last year in raising substantial amounts of money now from Barclays and Santander, amongst others, to lead the charge in actually, I think the Barclays partnership is probably the deepest bank fintech partnership that we've seen in the UK, mm-hmm. where actually the bank is saying we will introduce our customers to a fintech business to provide a service that we simply can't provide. And they've got lots of customers, and we've got a service that their customers would welcome. Often a challenge for fintech businesses is cost of acquisition and distribution. Well, Barclays have got 1 million SME customers. So the challenge, of course, is then getting the huge business to work well with an agile startup, and it's very early days. But we're really encouraged by the volume of leads we're getting from Barclays and the quality of the leads and the quality of engagement from their regional staff. So their regional managers, regional directors, who are the people who interact with their customers, have engaged. We've now sort of finished the national rollout extraordinarily deeply, and it's really exciting how that partnership's going.
Mm-hmm. Yeah, I think it is. It's one of the. I always say it's one of the most important partnerships that in all of marketplace lending. It's just a very, it's you've got a very well established bank, and it's a deep partnership, as you say. And I think it's going to be fascinating to see what comes of that. So then I want to move on to Creditech, which is another one where you're a chairman of the board, and it's a different kind of organisation. Although it's been around the online lending space for many years, and it's how did that come about? Because it's a different company. I think it's based in Germany and operates primarily, I believe, in developing countries. Just tell us.
The biggest markets for Creditech are actually the biggest markets are Poland and Spain.
Okay.
But yes, we also have a business in Russia. We have a business most recently launched in India. The original thesis of Creditech, sort of from way back when, was that it was going to operate in pretty well exclusively the developing world, and I think they found that very difficult. And by the time I joined, most of that had been closed or was in the process of being closed. So I was approached by some of the investors. So Creditech had raised substantial amounts of money from the private equity community, and in some ways it was a sort of still a venture capital stage business. And I think one of the difference being that venture-backed businesses are inherently have sort of more execution risk associated with them and a different risk-reward profile. And the private equity investors tend to come a bit later when there's a more proven business model and it's generating cash. So in some ways, I wouldn't mind me saying this, but I think some of the private equity investors invested a little bit too early and were caught up perhaps in a little bit of desire to participate in the fintech story without really understanding the maturity of the business. So I walked into actually quite a difficult situation, and for me that was part of the challenge. So I was keen to work with private equity investors. I think I know the venture community well. Raised quite a lot of venture capital from a number of people over the years and sit on a few venture-backed businesses boards, but I knew much less about the private equity world. And the PE world is quite a closed shop. I think as I made a decision to operate in a more sort of portfolio way with doing more board type work than executive work, I thought it'd be interesting to try and find a private equity backed business. Mm-hmm. And when I say it's a closed shop, I mean that they typically private equity boards are made up of ex-CEOs and CFOs of private equity backed businesses who've done well. And I have never been private equity backed, so therefore I wasn't in that pool. And I think the fact that it was they acknowledged that, one, it was probably an earlier stage business than they had thought it was when they invested in it, and two, it frankly wasn't doing very well, and the concerns around the management team, it was often the case, but there's some challenges. I think my background in having scaled a consumer lending business was helpful. Mm-hmm. So I joined it as a real challenge, and it's been a challenge. I mean, I've been there for just over a year now. We had to regrettably replace the management team, but brought in some really capable new executives who are turning the business around, re-platformed it, relaunched it on a new technology platform, top to bottom, and the business has turned a corner, which is really satisfying.
Mm-hmm, mm-hmm. Yeah, that's. Yeah, I've certainly noticed that there's lots of new names there on the management team at Creditech. But anyway, we're running out of time, and I do want to get to a couple more things. I know you've got other board positions that we won't have time to cover, I'm afraid. But I want to talk about UK fintech for a little bit, because it really has been on a roll, particularly the last 6 to 12 months. There's been lots of really big funding rounds, particularly in the sort of, the challenger bank space. So what's your view on the sector? Do you feel like, the valuations are getting ahead of themselves, or do you feel like this is all going to, these companies are all going to do well, and it's going to be, these valuations are justified?
Well, I'm going to disappoint you, because I'm not going to talk about valuations. I mean, valuation is in the eye of the beholder, and I don't think it's ever a good idea for anyone to comment on other people's valuations, other than to say that I think the market of investors places great value in businesses that consumers like that potentially could, disrupt huge industries, and banking is definitely one of them. So there's some logic to valuing a business which is acquiring customers at a great rate of knots, valuing that highly, and valuing the fact that the customers recommend it to their friends, and therefore marketing costs are very low. They're all very good signs, which I think do support valuing businesses like that highly.
Mm-hmm.
I think, is there room for all of them? Probably not. I don't think there's room for all the incumbent banks either. I think there will be some challenging times for some of the very big banks, the ones that aren't able to adapt to changing consumer behaviors, changing consumer needs and wants. And I think the institutions that go on to do well, the large institutions that go on to do well, are the ones that, and I don't think they've got it today, but create some agility in what they do and adaptability in what they do. And I think that means pretty big investments in technology. And I don't mean putting lipstick on a pig and nice front ends served by APIs. I mean actually some real engineering of back-end systems that allow for agile product development. Because I think that has to go all the way through the company. You can't just have a team of people who come up with fantastic user experiences at the front end underpinned by ancient, creaky legacy systems that are really hard to change and adapt. Right. So I think you're going to have to see some of the. Well, I think all the big players have to adapt to that, and some will not make that great. So I think there will be. I hesitate to use the word failure, but there will certainly be a diminishing of importance in some of the major institutions, and some of the startups of today, I think, will become household names and will go on to do extraordinarily well. Probably not all of them. Right. I certainly wouldn't want to pick the one I think that are going to do well and the ones that aren't.
Right. Well, apart from Zopa, of course.
Apart from Zopa, of course. Well, I think we're in a completely unique position. So we're in a position where we have the agility in terms of our tech stack, and we've built all the technology ourselves for the bank. And if I think back to the quality of technology that we used when we built Zopa in the first place, we've always built our own technology, pretty well always, since very early on. And the quality of the technology we're building today is absolutely leading in any sector, not just financial services, whereas you couldn't necessarily always say that about the past. Mm-hmm. So we're well positioned in terms of technology backbone. And we have a product which customers love. So we win all these awards for customer services and have an NPS score well into the mid-70s, which is extraordinary in financial services. At scale, we've got 500,000 customers. This isn't just a few people. Yet we've also got a business. So I think we can acquire customers in the same way as some of the other challengers. But we've also got a business that actually performs the bit of banking that tends to make money over the long run, which is called lending.
Right.
So I think we're in an extremely strong position to build a business that operates as an effective and profitable lender. We may well never have a current account. Therefore, we may well never have tens of millions of customers, but certainly single-digit millions of customers.
Right.
And as of yet, I think that makes us unique in the challenger sector.
Right. Well, I'm afraid we've run out of time, Giles. I could chat with you for another hour, but we're going to have to leave it there. I've always enjoyed chatting with you, and I appreciate you coming on the show today.
Not at all, Peter. Really good to speak to you.
Yeah. Okay. Thanks. See ya.
Thanks. Bye.
You know what Giles just said there about lending, I think is interesting. And these digital banks that are getting funded, both in Europe and in the US, many of them actually don't have any kind of lending operation. I mean, some do, but most of them do not. And it's, as Giles said, it's a profitable business. You look at banking and how and some of the largest banks are some of the most profitable businesses in the world. And one of the reasons that is because lending is a profitable business. And I expect we will see many of these digital banks, the ones that really become profitable and successful, will be those that have lending operations. That's my theory anyway. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's show was sponsored by Lend It Fintech Europe 2019, Europe's leading event for innovation in financial services. It's happening September 26th and 27th at the Business Design Centre in London. Registration is now open, as well as speaker applications. Find out more by going to lendit.com/Europe.